Good evening, everyone. Thank you for joining us this evening on the first installment of the Options Trilogy. I'm Crystal, the Community Manager at ProsperUS. Let me introduce our speaker for tonight. We have Chris, co-founder of Evergrow Fund, founder of RetainWealth.com, and founder of Value Investing Mentorship Club. Some places he has been invited to speak or have added value as a mentor or writer include Singapore Poly, SMU Institute of Innovation and Entrepreneurship, Sidley TV, Dollar and Cents, The New Savvy, Value Walk Blog, Investment Modes, NUS Investment Society, CGS-CIMB, Singapore Financial Conference by NTUC IIC, the Financial Coconut Podcast, Money FM, and internationally in Myanmar. A little about ProsperUS is ProsperUS is actually a digital investment service catered for the millennials. We aim to provide you with the best in-class service and to allow millennials to gain more insights on investing. We have specially curated webinar series. So with ProsperUS, you will not only learn how to invest, but also enjoy curated lifestyles at the same time. Check out our ProsperUS app on Google Play and App Store today. Follow us on our social media to keep yourselves updated on the latest news. Before we actually start the session proper, we would actually like to do a little short poll to find out what's your understanding on options before we begin. So let me pull out the poll first. Take some time to actually join in to do the poll. So the question of the poll is actually, what is your level of understanding on options? The first choice is actually beginners, second intermediate, and the last one is actually advanced. We can see that a majority of the attendees tonight are mostly at the beginners level on options. So we'll have Chris today to actually sort of like break down options for your better understanding and for more details of the other levels of options. You can actually join in the next few webinars. We'll be sharing it later towards the end of the session. Chris, I'll hand over the session to you.
Thanks, Crystal. Let me share my screen. Okay, all right, guys. Thanks for having me. I'm very happy to be here. This is a part of a 3-series educational webinars in partnership with ProsperUS on options. So, of course, as usual, please read the following disclaimer before I share further. The idea is that we are not here to give financial advice. We are here to give educational information and hope that we all here learn something from today, from tonight, and you guys have something to take away from investing your time, listening to me tonight. And also, while we are going through the webinar, please feel free to prepare some questions and ask some questions and put it in the Q&A tools of our webinar so that at the end of the session, I can answer it. So I hope that this will be an engaging webinar session, and I hope that all of you will take away something new tonight. So please feel free to and do not be shy to ask questions, okay? All right, so just a quick background about me. I'm Chris, co-founder of Evergrow Fund and founder of RetainWealth.com. So some of you may have read my blog before. I post usually at least around once a month. I post new articles, and I'm often invited to talk in outlets like, for example, Money 89.3 FM and other places like Sidley, CGS-CIMB, so on and so forth. So I love to educate. So that's my background. And I'm also the founder of Value Investing Mentorship Club. So Value Investing Mentorship Club is the educational arm of rethinkwealth.com. And the idea for Value Investing Mentorship Club is really to educate students and also to transform them in a way that they can acquire the skills on how they can invest properly in things that they understand, in companies they understand, and they can use this skill for the rest of their life. At the end of the session, I'll also be sharing with you a QR code if you'd like to learn more about Value Investing Mentorship Club. But while we are on this slide, right, I just want to introduce to you a quick overview of my 4M1S growth framework. This is more of how we generally look at things. So fundamentally, I invest in companies, I invest in stocks, I do not trade, right? So in general, we don't look at stocks as stocks, but we look at stocks as businesses, right? So even when I invest in options, I do not like to gamble or listen to stock tips, so on and so forth. The idea is really we have to understand what we are investing in through analyzing the management, the business, and make sure that there is mathematical sense in the price that we are paying. So we have to ensure that the price that we are paying for any stock, for any businesses, is way below what it is conservatively valued at. So of course, managing the portfolio, managing our money, and having the right kind of strategy in terms of, in this kind of scenario, should I go with stocks or go with options? So these are some of the things that I teach at Value Investing and Mentorship Club. And hopefully today, through this webinar, I'll also be sharing with you guys more things with regards to options, right? So I hope that you guys will benefit, especially I see that most of you guys are beginners. So let's start. Okay, so in general, I think it's good to start with the basic first. By the way, this is a options trilogy webinar, right? So there's three parts. Later, I'll also be sharing with you guys more on how to sign up for free for the next two webinars. So we'll go step by step. In each phase of the webinar, I will cover a little bit more advanced things, right? But at the start, let's start with a very simple understanding of what's the difference between options and stocks, right? So in general, um, options have the underlying there. So options pricings are based on stocks. Stocks pricing are based on the market movements and things like that, right? And stocks in general, you can trade both stocks and options in the stock market. So as you can see here, the similarities, options trade like stocks. They are actively traded in the stock market, but the price of options are generally based on the price of the stocks. So ultimately, how the stocks move at uh, which is the underlying part of the options, will result in the difference in the price of the options, which I'll share further towards the end of the webinar, where we are going to touch on more on how do the market price options. So there is not a fixed number of options as there are with stocks shares available. As you know, each company, if you look at Morningstar or if you look at Guru Focus, for example, if you look at, say, Facebook or Apple, you can know that how many shares outstanding are there in the company. So you can see that for this company, there's this amount of shares outstanding. So for options, there's not a fixed number. It's basically a derivative that has the underlying value in relation to the stock price. So stock owners, as you know, have a share of the company with voting and dividend rights, because I mentioned just now that stocks are not just stocks. Stocks are share ownership in an actual business, right? So options, on the other hand, does not give us any benefits in terms of voting rights or in terms of dividends, right? In fact, these are sort of like related also to the price of the options. Dividends are one of the factors, which I will cover later. So in summary, options are derivative, stocks are share ownership in a business. The price of options in general are related to the price of stocks. Okay, and options in general is like it's like a contract that is in relation to the price of the stocks and a certain time period, etc., which we'll cover later. Okay. In general, there are a few types of options, but just think of it in you can either buy options or you can sell options. You can buy a call options or you can buy a put options. You can sell a call options or you can sell a put option. Okay. So in general, these are the types of options, call and put. You can either buy or sell them. I'll go more in detail in the second webinar as well into the specific purpose of each of these types. But in general, the summary is that buying call option give you the right to buy the stock at a certain price. Buying put option give you the right to sell the stock at a certain price. So when you buy an options, you have the right to. You do not have the obligation to do it. But when you sell an option, you have the obligation to do it. That means that the first one, when you buy options, because you are paying for it, the way to think about it is like if you buy an insurance, right? You have the right to claim something, for example. Selling on the other hand, if you look at the point of view from the insurance company or the insurance agent, if you sell an insurance, if something happened, you have the obligation to cover the loss, for example, right? So that's the key difference. But in summary, the thing that you need to take away from this slide is that the types of options are calls and puts, and you can either buy or sell them. Okay. So in general, right, a person buy a call option if the person expect the price to rise. They buy put option if they expect the price to fall. They sell put option if they expect the price to stay the same or rise. They sell call if they expect the price to stay the same or fall. Okay, this is this is the surface level first. Okay, but in between these strategies, there's actually pros and cons, and there's actually risk involved, right? In general, uh, this is the purpose first. I'm going to share with you a little bit more later, but I do not want to overwhelm the majority of you guys with too much information right now. Okay, so in general, this is the general purpose, but in each of these purpose, there's actually thinkings and strategies and risk involved as well, right? So I'm sure like you guys will have some questions. Feel free to put it in the Q&A, and we'll have a engaging Q&A discussion later. Okay. But I just want you guys to know that for the purpose of this session, on the surface level, generally, this is the purpose of option. Okay, but in each of these category, there are risks involved. Okay, but for this webinar, I'm not going to share that tip yet because I don't want to overwhelm you guys first. So for this webinar, I'm also going to share a little bit more about options, right? Most of you are beginners, and like some of you may think, okay, like what is options and who actually use options? So I'm going to start with this guy, which I'm sure like every one of you, or maybe 95% of you will know, is Warren Buffett, right? And Warren Buffett has been known to write in his annual letters that he disliked derivative because he feel that derivative are, he called it a weapon of mass destruction and it's very dangerous. And he is right. He is right that options are dangerous, especially if we do not know the risk with regards to investing in option. Okay, but we can also learn from what this person do and not only what this person say, right? Because for Warren Buffett, he actually also uses option. He specifically used selling option. He used selling put option. So it's like just now I share with you guys, sell put options. But his idea is not necessarily to sell put option because he expects the price to stay the same or rise. He sell a put option, I think it is because um, he understands the other company well enough, and he sell put options to gain some premium. So I just introduced you guys another new term. When you sell options, you can get premiums. When you buy options, right, you actually pay premiums. Okay. So for Warren Buffett, he actually sell options and get premiums. But the idea behind it is that um, it's like providing an insurance uh, to somebody. Okay. And in return to providing the insurance, you get some premiums. And if something happens, he's ready to sort of do that thing. Okay. So in general, this is Warren Buffett. Next is Stuart Greenblatt. I'm not sure how many of you know Stuart Greenblatt. He's the author of the little book that beats the market, something along that line. He's a very successful hedge fund manager. He's a very successful value investor, and he himself uses options. I've read that he don't uh, sell options. The one that I read is that he actually buy options. So he buy options called leads, and he said that there is almost no other area of the stock market where research and careful analysis can be rewarded as quickly and as generously as using leads. So leads here is actually like buying call options when he expect the price to rise, but he buy it longer term. Okay, great. So now let's move on a little bit to in general for options, right? When you think about options, uh, have you guys ever wonder how do they price options? Because for stocks, we know that the stock price is hard to predict, right? But in general, the stock price is based on the demand and the supply. And of course, if the company have good earnings, if the company do well over the long term, naturally the stock price will naturally rise. But that's very clear because when you own a stock, you own a share in the business. That means that you own a part of the shares outstanding of the business. But how about options? So I wrote this article sometime back in 2018, but the information is still very relevant today because how they actually price options is based on this Black Scholes model, which was first developed by three economists. So two of them, Myron Scholes and Robert Merton, received a Nobel Prize in 1997 for their work in this model. So Black Scholes model is a very commonly used model in the industry to price options. And they also commonly term this as the options pricing model. Okay. And as the name indicates, it's used to price options in order to know the fair value or the raw fair value of the call or put options. Nearer to the end of the webinar, I have a website where I can share with you guys live on how you can use the calculator in the website for this Black Scholes model. So just now I mentioned at the start of the webinar that actually options pricing are based on the stock pricing also, right? Because it's a derivative. So in calculating the fair price, or should I say the Black Scholes model on how they calculate the options pricing is based on 6 variables. The 6 variables are time to expiry. So options have different expiry dates. It also depends on the current stock price. So that's why the stock price is very important. They will affect the price of the options, and they will affect whether you are currently in an unrealized gain or unrealized loss, or whether you can make your money or not. So in summary, if you're smart, your takeaway is that, hey, options are also based on the stock price. So that means that based on your strategy, um, ultimately it's based on the stock price movement also, which is one of the key variable on top of time to expiry, the volatility of the underlying stock, the type of option, the strike price, and the risk-free rate. Okay, so we can go one by one, and maybe in the upcoming webinars, I will try to share even more, right? But the idea is that it's based on these 6 variables. And how does this affect the price of the option? Okay, so you know that it is based on these 6 variables, time to expiry, the underlying stock price, the volatility, type of option, etc. But for example, if the time to expiry of the options is longer, will the options be more expensive or cheaper? Right. The answer is that the longer the time to expiry, the more expensive the options will be. Okay. The further the price of the underlying stock price at the time from its strike price. Strike price, that means that for the contract, for the options, what is the price that you agree on? For example, sell put at $5 for example, right? The $5 is the strike price. So in the options, there is always the strike price. There's always the time to expiry. How long is the contract? Then there's also, are you buying put or call option, or are you selling put or call options? So the further the price of the stock price to its strike price, it will be cheaper or more expensive depending whether it's a put or call option. Okay, the higher the volatility, the more expensive the option, and the higher the interest rate will cause put prices to decrease. So if you own put options, the put price will decrease at higher interest rate. If you own call options, the call price will increase at higher interest rate. So you can see how this is linked to the current environment also, right? The higher interest rate environment. So there's also a few more assumptions that the Black Scholes model used to come up with the pricing for options. So I mean, no model in finance, in my view, is perfect. And investing in itself is a combination of art and science, right? So even for Black Scholes model, there's two of the founder won the Nobel Prize. It's not perfect, right? Because they have to have some assumptions for the model. The first is that the stock does not pay any dividend during the option's life. And the second is that the Black Scholes model assumes that the type of option is European, which means that the option can only be exercised on the expiration date. So something new that you guys learned today is also option in general. There is European style and there's the American style. European style in general, the option can only be exercised on the expiration date. American style, the option can be exercised on any date before expiration. Okay, so for Black Scholes, it assumes that all the options, the type of options is European, which means that the option can only be exercised on the expiration date. The model also assumes that the stock market is efficient, which means that anytime the stock market may go up or go down, with both being an equal probability. Again, each of us may differ, but I personally do not think that the stock market is efficient all the time. But we can have a discussion on that some other day. But in general, these are some of the assumptions that the Black Scholes model used to come out with the pricing for the options. Okay, so I'm sure you guys will have some questions. So please ask the questions, okay, in the Q&A, and then I'll answer that later. Okay, and then the last important assumption is that the interest rate remain constant from the time the options were bought or sold, which again is something that is unlikely, right? Because interest rates go up and go down. So rising interest rate will result in the put options to fall in value and call options to rise in value, because theoretically costs are higher to buy stocks when interest rate rise. And that's why you see that the recent uh, market correction is mainly due to the rising interest rate. Then there's higher opportunity costs, and of course, companies that are that has too high of a multiple starts to go down. Okay, so this is how the original Black Scholes model formula look like. You can take a photo of this if you want. Uh, Basically, this is how it looks like, which takes into account the current stock price, time to expiry, the strike price, risk-free interest rate, and the implied volatility, or simply how volatile the stock is. Or they call it in a CHIM term, cumulative standard normal distribution. Okay, but don't worry. Okay, now I'm going to share with you this calculator. You can also take a photo of this. Let me share with you the website. Okay, so let's see. Okay, so this is the website, right? Wait, hold on now. Hmm, I think there's some technical difficulty here. Okay, this is the website, goodcalculators.com/Black Scholes calculator. So actually a long time ago, I found another website that also have a Black Scholes calculator, but that website is no more. But I'm sure if you Google, there's actually quite a lot of websites out there that have the Black Scholes calculator. Okay, yeah, so this is how it is. So the spot price is basically what is the current price today. Okay, so for example, let's have some example, maybe Facebook stock. Okay, I have some Facebook stock also. So let's say now the price is 188.64. So here you put 188.64. Then the strike price is depending on, again, what's the options that you choose, right? So uh, if let's say, for example, you sell a put on Facebook, let's say, uh, at 175, okay? Then the time to expiry is, let's say, 2 months. Let's say 2 months. Wait, maybe 150, okay? Let's say 2 months, okay? Then the volatility of the stock, we usually can see it in a brokerage account. So maybe like a ProsperUS might have it also. So let's say the volatility of the stock based on the deviation is say like 20%, and the current interest rate, let's say, is what, 1%. Okay, and let's say no dividend yield, because I think Facebook don't pay dividends. So based on this, right? Let's see what's the price. Okay, seems like the price is 0.01 for put and $38.90 for call. Okay, then if let's say we move this price closer to the current spot price, let's say 175. Let's see what's the price. Then the put price increased from 0.01 to $1.38. Right. The reason why this will increase when I increase this from 150 to 175, because at 175, for example, if you sell a put option, there's a much higher chance um, for the contract to be exercised, and you have to buy this at 175. But if let's say you put this at 160, this will naturally decrease to 11 cents because there's a lower chance based on the model, right? I'm not sure if there's a higher chance or lower chance, but based on the probability, uh, it's like that. Okay, so I'm sure you guys will have some questions. So let's hear the questions in a short while. So the purpose of the webinar today is simply to share with you guys first in general what are options, what are the different types, what affects the prices of the options, right? So we can start here. And then at the second and third webinar, I will try to go deeper, right, into what are the strategies of, say, like Warren Buffett, how he thinks about like selling options and things like that. Okay. Yeah. So if you want to like read up, also have it in my blog. You can take a photo of this. Then, okay, so that we have some time for our Q&A, let me share with you guys, this is the QR code for the second webinar. So you can just scan it first now. And in the second webinar, we'll learn more in detail. So I cannot overwhelm you guys with so much information today, right? Because if I do, then nothing gets in. So in the second webinar, I'll share more in detail on the purpose of why investors buy call and put, why they sell call and puts, and more importantly, what are the risks in doing them and what are the potential benefits. Okay, so you can scan this QR code now. So this for the second webinar. Okay. Okay, and then for the third webinar, I will go one step further, learn in even more detail. What are the option strategies that investors like Warren Buffett use to take advantage of the limitations of the Black Scholes model? So that means that in the third webinar, I'll be sharing more about what are the limitations of the Black Scholes model and what did like Warren Buffett say about that, right? And then we'll also learn some of the common option trading strategies that are commonly used in the market, such as bull call or bear put spread. Okay, so there's more learning in the next two webinars. You can just scan the QR code to join. Okay. All right. Great. Okay. So now we are at the Q&A section, and also remember I shared with you guys earlier in the webinar that I run a value investing mentorship club where our focus is really on transforming students on really acquiring the skill that they can use on how they can make their own decision to invest for life. So if you'd like to know more, you can just scan this QR code here to find out more about value investing mentorship and indicate your interest for 30 minutes free call with me. Okay, so you can just scan that and I'll share with you guys more about VIM and basically how it transform and change the life of many of my students. And while you do that, let's have some questions because I see in the chat there are already some questions.
Yeah. Okay, so maybe let's take a look at the first question from Chris. He's also Chris. So is this
Oh, hi,
calculator,
Chris.
is this
Yeah.
calculator for sell or buy contracts?
Hi, Chris. So this calculator is for both sell and buy contract. So they do not actually categorize it. Is it sell call or buy call? They basically just price it based on whether it's a call options or whether it's a put option. Then from there, then if you think about it, right, it makes sense because, for example, like just now, you see the put, the price, let's say, is at 11 cents. So if that is what the model is saying at 11 cents, that means that the market participants should be buying it at 11 cents. That means that I buy at 11 cents from you who is selling it at 11 cents. Should be something along that line, if I'm not wrong.
Thanks, Chris. We have another question from Kim Yap. Which bosses are active in options trading? I hope I pronounced that correctly.
Oh, okay. Hi, Kid. Yep. So, which bosses are active in options trading? Um, options is a very options are generally unique to the US stock market, right? And luckily, of course, ProsperUS also have that trading function in their platform. So the stock exchange are generally in the US market because generally options are in what they call the Chicago options exchange. And I don't think like we have like options in Singapore Stock Exchange or Malaysia Stock Exchange from what I know. Generally, it's always in the US Stock Exchange. Maybe because if you think about it, because the options pricing, right, is based on the underlying stock price. So if it's based on the underlying stock price, generally, like you will need, first of all, a very active and a very liquid stock market to facilitate the options market. So as you know, the US stock market is big, is huge, right? Maybe that's why there's more facilitation with regards to the options market in the US as compared to other parts of the world. Hope that answer your question.
Thanks,
Kian,
Chris.
yep, yeah.
There's another question from Tess, but I think just now Chris actually briefly showed the third webinar sign up QR code. I hope you have managed to actually scan the QR code. We'll move on to the next question. Okay, so the next question is, are options dangerous? Can I lose all of my money?
Options and stocks are both dangerous if we do not know what we are investing in, right? Because some stocks you may also go to zero. But options especially is more dangerous, especially if you are buying options or you're doing it on margins. But in general, buying options, buying call option or buying put option, you have a very high chance of losing all your money because I've read somewhere that most options that people buy expire worthless. So actually buying options is even more dangerous because there's a high chance of you losing your money. But selling options can also be equally dangerous, especially if you don't know what you are doing and you are just selling it for the premiums. And then when you get sort of like exercise, and if you don't have the money or you don't have the stock, you may face huge amount of loss also. But in general, I think we must understand what we are investing in through options or through stocks. And by doing that, we can refine our process over time and we can learn and grow over time as an investor. So I think that's what's most important. I don't know if that answered the question. Yeah. Yeah. So for those who missed out, here's the second webinar QR code. Then I'll show the third webinar QR code again also. I think Kian Yap have another question, Krista.
Yeah, I'm so sorry. Just now I think my connection was being cut off.
Oh, no worries.
Yeah. Just let me check again.
Yeah.
I don't see any on the Q&A tab, but let me just check.
I think it's in the chat tab. Given that okay, maybe I can just read it.
Yeah,
I think like
sure. Thanks so much.
yeah, Kenya was asking, given that selling put can suffer potentially unlimited loss, what will be the requirement by the exchange? Wait, I do not think that okay, so when you buy options, you generally your maximum loss is the amount you buy. When you sell options, right? I think in general, the exchange and the brokerage firm like Interactive Broker or like ProsperUS, etc., will actually have a limit and hopefully, I think they'll have like a limit in place lah, based on the amount of capital you put in the brokerage. This is the amount of selling put options, for example, that you can maximum sell based on this. Yeah, so it's usually a requirement. So the limit is usually done by the brokerage, and and like any reasonable brokerage will have that limit lah. Because like cannot be like your brokerage, let's say you only put $500, then you cannot be like selling put options with exposure to, let's say, $100,000, right? So I don't think that makes sense. Yeah. Hope that answered the question, Kenya. Okay, this is for those who missed out the third webinar QR code. You can scan it again here.
Maybe just want to check, is there any more questions? I'm so sorry, just now I was being kicked out, so I can't
Oh,
see the
no
questions.
worries. I think like Clement was asking, can trade options via CGS-CIMB platform?
Yeah,
So
correct.
yeah.
I'm
So
sorry, Chris, go ahead.
yeah. So maybe like Crystal, you can answer that.
Yeah,
Can you trade?
definitely. Definitely. Yeah, you can actually trade via ProsperUS. Chris, would you like to show them your account? Your account that you are using for ProsperUS?
Oh, yeah, I have an account, but I think I have to log in first. So maybe next
Okay,
time.
okay.
Yeah.
Okay, sure,
Stay
no
for the
problem.
second
Yes,
and third webinar to see.
sure. ProsperUS, with ProsperUS, you can actually trade on options. So I'll just share the link about a ongoing promotions for options trading, and as well as the pricing for Clement lah, in the chat box. I'll just send it over.
Yeah.
Okay, next up, we have another one, which is, how do I know if I should invest in options or stocks?
Oh, I think in general, it depends on your strategy, right? So whether you should invest in options or stocks have got to do with your time frame and also your understanding and your valuation with regards to the company, which we teach at Value Investing a mentorship. So feel free to scan. But in general, right? In general, options have more element of market timing, especially buying options, which is also the dangerous part if we do not understand it, right? Because again, it's very hard to time the market. In comparison, if you buy stocks, you generally do not have an expiry date as to your holding of the stock. And if you buy options, there's also this thing called time decay. That means that as the time passes by, your option value actually decreases. And nearing to the options expiry, your like the amount it decrease actually goes exponentially down, right? Especially if the current price is still below the strike price. So if the current price above the strike price, then there's the intrinsic value. But I will cover more uh, in the future lah. In general, whether we should invest to stocks or options, depending on your time frame with regards to that company, and also the difference in terms of the price to value with regards to the company.
Okay, thanks, Chris. We have one last question, which is on what is the capital I need to trade one option?
The capital that we need to trade one options is that, okay, for the US market, right, you can buy as little as one stock. In the Singapore market, if I'm not wrong, is one lot is 100 stocks. So in the options market, we go by contract. So one contract is 100 stocks. So that means that if let's say you are like if let's say you are selling a put option, and then you are getting a premium of, let's say, $1, and you're selling one contract, so it's 100 times $1. You get $100 as your premium. So that means that it's usually in the notion of 100. So depending on the premium that you're paying or you're getting with regards to the options market, that is generally the capital. But I would say in general, why some people like options and why many people use it as a way of gambling, which is wrong and dangerous, is that a lot of people think that they can have exposure to bigger amount of stocks, but through options, so they can put lesser money. So in general, with options, most people can start with lesser money, but again, there are risks involved. So you have to understand those risks clearly.
Thanks, Chris. I think we have come to the end of the session for tonight. So shortly after this webinar, right, we'll be actually showing a QR code or a link of the survey that you can actually help us to fill in so that we can better understand what we can do for you better in the future sessions. So it will not take longer than 5 minutes. Thank you so much. What we can do for you better in the future sessions. So it will not take longer than 5 minutes. Thank you so much. What we can do for you. Thank you all for attending the webinar tonight. It will not take longer than 5 minutes. Have a good night, everyone. Thank you so much. What we can do for you. Thank you all for attending the webinar tonight. It will not take longer than 5 minutes. Have a good night, everyone. Thank you so much. What we can do for you. Thank you all for attending the webinar.
Thanks, guys.
It will not